Following on from MAPB, this is MAPI. So in the first quarter, sales slowed down. They were growing faster than the market from 2018. Now it's only 1% in the first quarter, which is only 1% difference from what we had forecast. The breakdown, the retail is the slowest, -9%, and interestingly the department store is doing the best. And then F&B, as we know from MAPB, is -3%. So we're forecasting that sales will fall in the second quarter, and then there'll be a recovery, but minus almost 4% growth for the next 12 months. So in cash flow, the last 12 months is positive. They had this great run of cash flow, but the first quarter is very negative, and that's dragged down the 12 months to 854. Even though we're forecasting slower sales, we're forecasting less investment, so we get a free cash flow next 12 months of 960. So a little bit higher than it was. In the balance sheet, this was such an amazing story, all the way to almost, with all the cash flow, almost net cash by the fourth quarter, but they've added 1.1 trillion to the debt in the first quarter, so it's now back to 1.2 trillion. With our cash flow forecast though, the net debt would come down to 261, assuming there's no dividend. So it would come back up again, almost to net cash. In terms of profit, there is an FX loss. The profit drops more than 80% from first quarter to first quarter. The cash cost ratio is the same, 92, and we use 92 for our forecast. Now, one thing a little bit odd, the depreciation has jumped in the first quarter. Not quite sure if that's going to repeat. We used the previous depreciation, but we still get quite a bit lower net profit, 749 billion in the next 12 months. So here's the cash flow with lower investment spending and using our 1.6% valuation with a big discount, 60%. I don't know, I mean this has been quite a cheap stock. So without that, the target would be pretty high, and that gives a target price of 1436, which still looks like a re-rating.